Good day, fellow investors. Let's go through some of your great suggestions in the comments. I am very grateful for that. And let's immediately start with Visa and Mastercard. We haven't discussed them for a long time, but what's going on? Are those a buy? And actually, given what's going on, the stocks will likely keep on going higher. Because if you look at Mastercard, great, since the IPO, I remember considering buying it here, and one on a local forum wrote that we should buy it. It has been just a rocket to the moon. The P ratio is 30, in line with the markets, and they just keep on going higher. Similarly, Visa also booming, P ratio 30, in line with that. And if you look at things here, you can see growth in revenues, growth in profits. The business models are so good. Keep in mind this growth is the real inflation that we are having. So 5 years, prices have doubled. That's what also is a tailwind for these businesses. However, they also great margins, great cash flows, and they can now spend more than 20 billion on buybacks. 20 billion on buybacks on 600 billion market capitalization. If we look at the market inelastic hypothesis, which looks at flows of funds and looks at how much $1 into a market that is not liquid enough for 600 billion, as the market cap shows, pushes the market cap $5 to $8 higher. That means that if you have 20 billion of flows, plus passive income, things like that, you can expect 100 billion market cap increase over a year. That is what is driving the stock and will keep driving it. And that is just that will give you a 15% return on Visa stock because the cash flows are stellar, everything looks good. The P ratio 30, so in line with the market. However, if we look at Visa's performance over the last 5 years, it's just 57%. So it likely underperformed the market. However, when we look at where Visa's P ratio was back then, 40 going to 50, pandemic, things like that, protection, zero interest rates. Now interest rates are a little bit higher, so a P ratio is 30 is correct. The only thing that can be a risk to this thesis is the P ratio game. Can it go to 20 where Visa would keep on growing on inflation, on buybacks, on everything, but your return might not be that great? If we look at the P ratio, I don't think it even touched 20 in the last 15 years. So maybe 25 is the biggest risk, which is a little bit of downside. Keep in mind the stock will keep on growing. So from a risk-reward perspective, Visa now is a buy. Consequently, Wall Street analysts are giving it a buy with targets, upsides for the next year, 15–18% in line with that situation that we have. Risk, perhaps some disruption, laws on credit card issuers, things like that, a recession that might push maybe the P ratio a little bit down to 20, little bit of stagnation, and that is the key risk. But from a risk and reward perspective, looks very, very good. The lowest P ratio was 22, so really in the midst of the crisis 2014. So this looks great, looks safe, high cash producer, margin of safety also a little bit there. All else, the stock will just keep on creeping up, all else equal. Also, the same story holds for Mastercard. So, very, very interesting situations there. Great businesses, profitable, buybacks, pushing stock price higher. If you want to ride the wave, it looks like it is the game to be. There are some discussions about tokenizations, things like that, changing the system. Not in the short term, you need also political and things like that to change that. I hope there is more freedom in that transaction, lower transaction costs, things like that. But for now, these are the dominant players spending money on buybacks and therefore likely pushing the stocks higher. Now, Udemy, the stock is down. Is it value or a value trap? Udemy, or however do you pronounce that. The market cap 733 million, P ratio negative, dividend no negative. And if I look at the investment highlights, yes, 5-year revenue growth, everything looks great. But if I look at the revenue growth last quarter is 0. And that gets priced in. If you grow 0, if you are not making money, the value is 0 or value that someone can take you over. And that's the key risk. If someone takes you over at 7 or the stock price goes to 3 and someone buys you at 5, you haven't made much more money. That is the risk with these businesses. The outlook is, okay, I'm profitable, some EBITDA. The question is, what will turn the ship? For my research platform that you can check in the links in the description below, I pay, I think, $1,000 for everything, processing money, upload, everything. So there are competitions I constantly get from other providers. When you should do this, they go with us for even lower prices. So yes, when the pandemic was, everyone was rushing towards these things, the courses, etc. The company smartly went public when it was the right time, but this is most likely a value trap. Of course, everything can happen, but okay. Sprout Farmers Market, very interesting situation. It boomed on growth, then it declined. I discussed this when I was still skinnier 4 years ago. Now I'm working on it, lost already 4 or 5 pounds, but we'll get back to this. However, good grocery stocks, not 10x, but 8% returns were expected 4 years ago. Of course, that happened also with the correction now. So let's see what's going on there. I've looked a little bit at the numbers, the last deck. Everything looks great. Still 13% growth, P ratio of just 15, market cap 7 billion, good gross margins, EBIT margins improving. Strong balance sheet, they are repurchasing shares, they are also investing in further growth. Total sales growth 14%, comparative 7%, so opening new stores, expect to open more stores, diluting earnings per share 5 to 5.28, everything looks good there. Net income growing, profits growing, spending even more on buybacks in the last 12 months than last year. So 10% growth, 5% buyback yield. What's wrong here? The stock is getting destroyed, but immediately you can understand it is a growth story. So Sprouts forecasts comparable sales in the range of 0 to 2%. So only growth, yes, they will open new stores, so that should lead to growth. We are lapping some tough numbers, and then again this consumer context, the weak consumer. So that's something, okay, if that turns, the Fed lowers rates, prints money to help the consumer, pushes inflation higher, that should be a positive for Sprout markets. So 0% growth, it is a retail, highly competitive situation, and then the question is, what next? When we look at Buffett, retailing is a tough business. I watched a large number of retailers enjoy terrific growth and superb returns on equity for a period and then suddenly nosedive, often all the way into bankruptcy. In retailing, the cost is to fail. That's something that is simply a nature business. You have to think about this when it goes to your exposure to these things. There are no moats, the turnarounds are risky, highly competitive, and Sprout Farmers also. If you do something that works, all the other bigger players will, okay, let's introduce organic, let's do this, and that trims your margins so you can grow until you can't anymore. Despite that, Wall Street still has a great target, strong buys, everything great, 56% upside, 200 stock price, the highest target. And they were correct. Some analysts here saying it is a sell when it was peaking. Now more and more they are saying it's a buy. Of course, they have corrected their targets as the stock goes higher and lower, that is Wall Street. And when it comes to my opinion, it looks interesting, but I really don't know with retailers. I've just looked at the IX index, we have Ahold, they are also going into the States, growing. They are still growing 2%, 3% in the US. And then it comes to the retail cycle. We are now before the early peak maturity, what Sprout Farmers enjoyed, and then going into early contraction. Possible further downside on that consumer sentiment, recession, you buy cheaper things a little bit. So it is interesting, but just if I can give you some value, think of what Warren Buffett said, go back to that part of it, you read a little bit, and then just size your position accordingly if you are into this. Turnaround, stock going bad, it's very difficult to know. Now, we have Adecoagro and Global Shipley's. We have analyzed Global Shipley's in this video, so go there for that one. Let's discuss Adecoagro. Adecoagro, if you look at the stock price, has not done much over the last few years, just the dividend. So they are crushing ethanol, sugar companies. Okay, they produced more ethanol energy because of the better margins there, company from Brazil. However, if you look at the situation, they are planting, gross sales down on lower prices, likely EBITDA down a little bit. They have a farming business, they are investing. So sugarcane production, ethanol, they bought this plant from Nutrien, which is very interesting. Capital allocation, okay, distribution lowering down because of the lower margins, but they have increased the debt a little bit, making things riskier. However, if we look at the situation here, sugar, food, everything should be great, and they should have made a lot of money over time. So they did grow revenues over time, but you can see here how the profits, the green ones, have constantly been struggling. A little bit of great profits in the last 4 years, but then now we are going again to no or little profits. Plus, they should have made more money because the food is priced in dollars. Brazilian real has been hammered over the last 6 years. Okay, it is what it is, but Adecoagro has been bought by Tether, so they have acquired first one stake, take another stake, 70% stake. So Tether is now the key owner there. It's a type of stable coin. They say the market capitalization of Tether is 180 billion. You tell me if that is correct or what. And now the question is, will they buy you out at 12 if you can buy at 7, but you depend on what that does. That's just 12 Tethers per your stock. That's now the situation. This is not an investment anymore. This is a bet that someone will buy you out at a higher price. The market cap $184 billion. So if that is correct, $184 billion went into this token. Correct me if I'm wrong in the comments, please. But okay, now it depends on what the owner will do. Are they buying it to pay themselves a dividend? Play around with the fact is that the owner sold to Tether, and now you can see whether you can keep on holding things like that. It is a business sell, and now you have the bet on things. So thanks for watching a lot of bets. Check what I own on my research platform, and I'll see you in the next video.